session. So my name is Hesbon Nyakundi from the Kenya Bankers Association, and I'd like to welcome you to this mentorship webinar. This webinar is part of a series of webinars being coordinated by the Kenya Bankers Association under a program called Inuka Enterprise Program. This program seeks to build capacity among SMEs, and the intention of that initiative is really to support SMEs to be able to run smoothly and to be able to enhance the opportunities to access credit or loans. Today's session is being coordinated in collaboration with Cooperative Bank of Kenya, which also happens to be a KBA member bank. Our topic today is key debt management strategies to boost business performance. And who is better placed to address this topic than our guest today? His name is Mr. Moses Gitau. He's the Cooperative Bank of Kenya Head of Business Banking. He will address all aspects on this topic. And as he makes his presentation, please remember you can engage. Please post your questions. If you need any clarifications, please feel free to post them on the chat box. I'll keep track of all that, and then we'll be able to address that at the end of the presentation. So at this moment, without any further ado, I would like to take this opportunity to welcome our speaker today, Mr. Moses Gitau. I've said before that he is the Cooperative Bank of Kenya Head of Business Banking, and he'll share with us insights on today's topic. Welcome, Moses.
Thank you so much, Hesbon. Just before we begin, let me take this opportunity to invite Peter from Cooperative Bank to say a word of prayer. Peter.
Thank you, Moses, and thank you so much, Hesbon. A very warm welcome to our customers. And before we start, let us bow for prayer. Our dear Heavenly Father, this morning we want to thank you. We want to appreciate your goodness and your mercies for being together with us. Thank you, dear Father, for this opportunity you've given us to learn. As we talk about debt management today, we pray that, Lord, you give us insights that are hoping, dear Father, to support our businesses. And as we try to implement some of the tips, we pray that, Lord, you be able to help us, help our businesses, and even support our customers' business. As we start this session, may we be together with us. In Jesus' name, we pray and give thanks.
So thank you so much, Peter. Thank you, Hesbon. Good morning, all. I wish to take this opportunity to welcome us all. And before I go to my presentation, just as introduced, my name is Moses Gitau, Head of Business Banking in Cooperative Bank. So business banking, I take care of all the needs of the MSMEs, the micro, small and medium enterprises. This is in regard to transactional needs, the lending needs, and also the non-financial needs for the MSMEs. I also take care of a product called asset finance and IPF, that is insurance premium financing for the bank. I'm a career banker, and just as Hesbon put it, I'll be taking us through the topic of key debt strategies to boost business performance. Before that is to recognize the presence of the KBA staff. I know I have Hesbon and Rosin at the back end, and all the team and the Inuka Enterprise Fund, and also my colleagues in Cooperative Bank, and more importantly is the customers that are listening to us. I think just to say, as a bank, Cooperative Bank has continued to support through online engagements to equip customers with insights and information to thrive in business. This is just one of them. And just as Hesbon said, today we are partnering with the Kenya Bankers Association, and specifically under the Inuka Enterprise Program. And would want to share and learn from each other in terms of the key strategies to boost business, in terms of the key debt strategies that will help us in terms of boosting the business. With the continued opening of the economy and the improved environment, we are very hopeful of the full recovery in terms of the businesses. I know we are coming from a period of almost 2 years break because of the COVID. But I think there is that hope in terms of the recovery, the opening up of the improvement of the business environment. However, business operations and interactions may never be the same. I think we may never go back to where you are in the previous dispensation. And the Co-op Bank, as a bank, we do these kind of webinars every Thursday, same time. And as I said today, you are partnering with the KBA. And in case you have not been part of it, you are welcome to join our other webinars that happen every Thursday at the same time. We have had in the previous sessions partnered with several key stakeholders. We have also gone for looked for opinion leaders in the forums, just as a request comes through from our customers. Our discussion today will be on key debt strategies to boost business performance, and this is very critical for any business entity aspiring to grow. So I hope as we discuss, as we go through, we'll pick something that will help boost your business, or maybe you'll also be learning from you. So I take this opportunity to welcome us all. Let's fully participate. Let's give feedback, share your experiences, and ask questions through the chat box. And I think above all, I would want us to learn together. So I would want to go straight then to my presentation in terms of this topic today. Thank you. So our discussion then will cover, we'll be talking about borrowing considerations. We'll be talking about selection of loan type. If you are to borrow, what kind of loans do you go for based on your needs? We'll also be talking about differentiating between good and bad loans, I think, which is very critical, even at a personal level. And this also will help us differentiate between a personal and a business loan. Loan management strategies, because this is very key. Once you are going to borrow, how then do you manage that facility? Then maybe at the end of the presentation, I'll also be talking about the Co-op Bank MSME loan solutions. I know I have a number of customers here from Co-op Bank and also others who are not with us. So I'll be talking about what solutions do we have as a bank in terms of supporting the MSMEs. And then we'll be going to the conclusion. Why is this topic important to us and even to you as an MSME, be it a personal business or a registered business? I would want to say that utilizing and controlling debt effectively is a key factor to personal and business success. And I think you all agree with me on that statement. And you're also saying debt is very beneficial to businesses when managed well, but the debt can also sink a business when it's neglected or mismanaged. And I think we all agree with me on that statement. So in terms of then the training, what would be the benefit in terms of the training here is to say it will help us access more credits for business growth, match your own products to your business needs, again, differentiate good and bad loans, and manage your loans better. If you are to borrow, how then do you manage your loans better? And I think I'll also be discussing how then what the type of loans that will come in handy based on the needs that the customer has. So my first topic is borrowing considerations. And with this, I would want us to do an exercise. And this, I would want us to do through the chat box. This activity, I would want you to indicate from your end, what do you consider while borrowing, while taking a loan facility? What is that thing that you consider? I'll post there maybe for 1 or 2 minutes so that we can chat through the chat box. We can put our answers to the chat box. Indicate what you consider while taking a loan facility. Again, indicate through the chat box what do you consider when you take a loan facility. And Hesbon, maybe you could continue reading what the customers are saying as they chat. What is the consideration when taking a loan facility? Husband, I see there are many coming in. Maybe you could take up a few.
So thank you. I've seen some representatives are saying the cost of the loan, the first consideration. The other consideration is interest rates. The other consideration I see here is on the cash flow. The other consideration is the purpose of the loan. And then I also see another consideration here from Edith about the intended use.
Excellent.
Then there is more payback period is another consideration. And then we have another feedback from Emma who says the need they have is a consideration if the need is urgent and if and the available sources. Those are some of the considerations we've seen from the participants today.
Excellent, excellent. I think we are much together in terms of that discussion. And basically, as a summary, based on what the customers have said, the participants have said, in terms of consideration, we look at the need of the loan. And I think it's very important to say there are two basic needs when you're looking at a facility from a bank, and when you're looking at financing your business. Number one, it's basically the need, and that need, it will be either a working capital need or an investment capital need. And working capital needs is when you're buying things like stock, or you're financing contracts, the day-to-day operating expenses for the business, be they salaries, be they payment of electricity bills, payment of water, those are what we call, that's what we call working capital. Then there is the business expansion. And of course, what I said, the need for investment capital. You want to purchase a motor vehicle, you are looking for a building, you are looking for machinery, or even looking for fixed assets, you are looking for rent. That's what I call capital expenditure. But the day-to-day operations of the business, the stocks, the contracts, the operating expenses, that is basically what we call working capital. So it will be very important as you enter into debt to clearly understand the needs, because the two needs will be served differently, and the two needs maybe have different cash generation cycles. The second thing that you need to consider is what are your funding options? Is it a bank? Is it a SACCO? Is it your supplier? Is it your family? Is it friends? I think then the source of funding becomes also very critical. And then the other thing that is very key, and this comes in at analysis level, when we are now analyzing the credits, we look at what we call 5 C's. As a lender, any lender, even if you are to lend your own money, I think you'll be looking at the 5 C's, the character of the person, because even if it was your own money, not even a bank lending to you, would you lend to a person that you know has a bad character? The second thing that you look at, the second C, is what we call capacity. And capacity is what we call the ability to take on and repay the debt. And I think this again is very critical, because even at a personal level, if you are to lend money to me, you consider my capacity to take on that debt, and at the end of the day, repay back to yourself. The third thing that mostly is considered when you are at the bank, maybe it's not at that personal level, it's collateral. And even at personal level, some people will say, I cannot rent to you if I'm not holding maybe your logbook, if I'm not holding your shares, if I'm not holding your fridge, such household items. So collateral is key. It's not only to the bank, but even when doing those personal decisions in terms of lending. I think the other C is capital, and capital here is the money that you put into the business. What is the consideration at your end as an investor? what is your stake in that business? I think that is key, and that is what we call capital. And then the other thing is conditions. Each facility would come with conditions. You would say, even if you are to lend at a personal level, I think one of the things that you say is you have to understand when the money will be paid back. If it is installments, when are the installments due? If it's some conditions that you have to attach to that facility for the borrower to pay you back, what are those conditions? So in terms of analyzing the render's consideration, when analyzing, the renders consider character, capacity, collateral, capital, and conditions. Those are the 5 C's that are very key in terms of lending. I think the other thing that we consider is a source of funding, and I've had a number of us talking about it. And we have several sources, and for today's purpose, I think I would just want to dwell on a few. Number one, if you are to do that, maybe to either to whatever to do business, you could consider personal savings, and that is money now, personal savings that you lend to your business. The cost on this, maybe it has no cost, it has no terms because it is at your own terms. The advantages is that it's easy because it's an easy way and cheap in terms of consideration, and the risk is minimal. The only risk is losing your personal savings. I think that is the only risk that you will get from your end. The other thing that we'll be considering in terms of the sourcing of funds is basically from friends and family. Again, this is usually good. It has no rate, or sometimes they don't lend to you at a rate, or whatever. If they have to consider some interest, will be very minimal. There is flexibility in this, and I think this is a good one, where you are saying now is a family or relative lending to the business is flexible, and has, in terms of advantages, is flexible and gives best value, because again, your attitude in terms of negotiating the terms and the conditions. But again here, it's limited. If you are going for very high debt from family, I think this may be limited in terms of the exposure, because they may consider maybe a lot of factors based on the relationship and what have you. So the limitation, I think, is a disadvantage, and also it can cause some friction in the family. It can create friction in the family, and I think that may not augur well. So that's why most people would look for private funding. The other source of funding, and I think this I would want to emphasize to people who are in business, is from your suppliers. You are buying goods from a supplier, the cost is free, and sometimes it's important to negotiate the terms. If you are given 30 days credit or 30 plus days credit, I think that is a source of funding. So you are collecting goods and paying them after you sell, and maybe 30 days is a very good source of debt from your suppliers. I think the advantage of this is that it's not expensive, and again, it's unsecured because it is in exchange of goods. The disadvantage here is that sometimes this may be short term and may be only restricted to the items that are being supplied. So assuming you have several business lines, you have several items that you sell, it means if you are picking credit on one line, it means the other lines may not have credit. So it's limited in terms of restricted to the areas that the items that you are supporting. I think the other source of funding is banks, and I sitting from Cooperative Bank, I'll tell you this is a very assured way of lending. The only thing that borrowing from banks, it goes with the cost, and that is interest. I've seen a number of you asking about interest. Currently in the market, you will see between the banks, sometimes it ranges between 10 to about 13%. So the good thing, the terms here are 1 month to 120 months. Here, it is your capacity that is analyzed, the business capacity. Unlike the rest where you are saying you are being analyzed by a family member, you are being limited by personal savings, here it is the business that is being analyzed. And we are saying, in terms of advantages, it's highly available. Banks, facilities, they're highly available. As far as the borrower, the applicant meets the conditions that the bank sets. And here, what you're saying, when a bank comes in, it comes in as an intermediary. There will be that person who has savings, the personal savings that you talked about there, the friends or the family savings that you have up there, the suppliers that you have up there, all that savings lumped together will be held somewhere in a bank in terms of deposits. And then there will be this person coming in to borrow as a business, saying that I require some funding. So the banks come in as an intermediary saying that we'll be getting this money from customer X and lending it to customer Y. So the bank does not have its own money. And that's why we are saying for this, we must meet the conditions as set by the bank. Conditions must be met before access, because the money that the banks lend is not their money, is depositors' money. Is all the money that is aggregated there by the depositors, that is what banks lend. So it has to be given out in a very prudent manner, such that it comes back. And at the end of the day, the person who did their savings, the person who brought their personal savings, that friend who did or the family member who did a savings, that supplier who sold and deposited in the bank will come and get back their money once you repay back. I think lastly, the other financials out there, many, and I think you have heard of people who do money lending. The cost here may not be controlled because most of them may not be regulated, and they'll be exorbitant in terms of cost. Some will go as far as high as 25%, maybe slightly higher, quite higher than the banks. And for them here, in terms of conditions and terms, I think they'll do it on monthly basis because they would want to. They are limited in terms of capital. They do not have a lot of money out there to lend, so they will give short-term loans that are usually monthly. This, I think, the disadvantage here is that they may be expensive and can cause the borrower to fall into a cycle that is very difficult to come out of, based on the continuous borrowing that they will be doing on monthly basis. But the advantage on it is that for those cases, they are easy to get, the immediate minimal requirements. So they will be expensive. They will be they may cause some trouble, but they are easy to get and with minimal requirements, but at very exorbitant rates. So basically, those are the sources of funding. What I said: personal savings, friends and family, suppliers, banks, financiers, and I know you can mention several. But basically, for me, that's what I wanted to share with the participants today. The other area that then we consider is analyze borrowers. We analyze the borrowers' considerations. And for this case, it's very important to say what type of loan products are they, short-term or long-term? When I talked of working capital and investment capital earlier, short-term loans being working capital being that you want to finance business will be categorized as a short-term loans. And long-term loans, assuming you are buying a house, it may not give you a return immediately, be it a business, be it a personal residential house, be it a motor vehicle, it may not give you return immediately. Those could be considered as long-term loan. But the loan that you take to finance stock on day-to-day basis, that you buy in the morning and maybe sell in the evening or sell after a few days, that should be considered as a short-term facility. Then the repayment terms, very critical. For this, I think it will be very critical to say, as you borrow, what terms are you borrowing on? Is it a monthly installment? Is it a term-based installment? Or is it a bullet installment? So those terms are very important. Number one, when it's a monthly installment, it means then your business has to be able to generate monthly cash flows. If it's termly, and this goes to people who are in businesses like schools, it means your business perhaps will be generating income on termly basis. And when it's bullet, when we are saying it's a bullet, it means you are financing a transaction. You've gotten a business to supply, you paid, and once you are paid, you pay the bank. So basically, that's what we call a bullet payment, based on the terms that you have agreed with the lender. And I think this is very critical because it's one of the problems that you see where debt is mismatched. You have some income that comes on quarterly basis, but you sign a contract to pay on monthly basis. So for the first 2 months of the quarter, then you struggle. So basically, that's what you are saying. You need to match your income to the expectations and the repayment ability of the business. I think I've had the issue of cost of borrowing, a very key consideration, and this goes to interest rate, not only to interest rate, but also to the loan processing fees, because you need to look at the profitability of the business you are doing vis-a-vis the cost of that borrowing. And I think I don't need to dwell on that because it's there. You also have things to consider like legal fees. If you have to do some legal charges, if you have to do some contracts, you have to involve some insurance companies. I think it's important to have that consideration. The other thing is insurance fees, the total, what we call total cost of credit. So for a bank, if you're borrowing from the bank, banks will disclose to you, and I think these days you are mandated to give a customer the total cost of credit. It includes interest rates, all the processing fees, all the fees that comes with that, and it's very important to consider that cost as you go to the bank. I think the other consideration is the issue of loan repayment period, and this will help you achieve the desired objectives within the tenor. So just as I said, if it's working capital, it should be a short-term facility. If it's investment capital, it should be a long-term facility. So the loan repayment period, I think, will be very critical. And most banks, as I said, you'll have facilities for a month all the way up to 120 months. Some will go even to 80 months, depending on the need of on the type of project that the customer is doing, the type of the business that you are doing. I think the other thing that is considered is security or collateral. That is, banks will have what you call secured or unsecured facilities. Some will have partially secured facilities, and some will have what we call hybrid, where you have a mixture of securities. So security, collateral is also important, but as I mentioned, there are those who then will even get unsecured facilities, and the market now has a lot of unsecured facilities in the banks. I think the other thing then we need also to look at in terms of analyzing the borrower's considerations is ability to repay. So as a lender, even if it's at a personal level, you should be convinced that the person you are lending to has the ability to pay. The business that you are lending to has that ability to repay back, and not external sources. So what are we saying? If I'm funding a barbershop as an example, it means that barbershop has the ability to repay, maybe after a certain period if it is a new venture. But if you see the business, if you see that you are borrowing money or throughout the period, and the source of repayment is external, it means that business cannot sustain the repayment ability. So it will be important to say to have your records just to help you determine whether your business is able to meet the monthly installment and even pay the workers, pay the bills, and even pay the bank facilities that come through. Then the other thing to consider is amount to borrow, and this is very critical because from what I see mostly, if you underfinance a project, it becomes a challenge, or a business. If you overfinance, again, it becomes a challenge. So it will be very important as you sit down to document and say, I need money for A, B, C, D, and this is the exact money I need. Rather than just say I need a certain amount of money and I'm not very sure what I'll go do with it. So if you are underfinanced, it means you will not complete your business, you will not complete your project, you may not have adequate stock to whatever to help you support your business. Or if you are overfinanced, it has a tendency of making you divert that money. So it will be important to say, I'm looking for this exact amount, and this is exactly what I'm going to do, so that I'm not overfinanced or I'm not underfinanced. The other thing that then also need to be considered is existing debts, and this we call them debt ratios. And from a lender's perspective, mostly when we have a debt ratio not about 70%, it becomes a challenge, even at a personal level. When you're doing even your household budget, if your debt ratio is above 70%, I think is a big problem. So it's important then to say, what is my debt ratio? When it's below 40%, 50%, as an institution, we do consider, and it's very important for businesses to be at below 50%. Then the other thing that we need to consider, that I had it coming through the chart, is purposes. The purpose for borrowing. Must you borrow? I think that's a question that you need to ask myself. Must I borrow? Based on all those factors that you say that borrowing has a cost, borrowing may have some fees, must you borrow? Then the business cash flows, I think that is very important to say. am I able to generate adequate business cash flows? So we are saying here, do not borrow as an emergency. Have a plan and a strategy before taking a loan and analyze your repayment. So borrowing, I think, should not be taken as an emergency unless it's an emergency happening, something that was not planned for. But for business, it should not be as an emergency. We need to have a plan and a strategy before taking the loan, and also analyze the business ability to take over the loan. I think the other thing that we also consider, and I think this now elaborates the 5 C's, is the character of the 5 C's that I'd mentioned. When looking at a loan application from the bank side of it, the 5 C's that I mentioned, that is character. And I think this goes also to even when you do the personal lending. Does that person have ethical values? Do they have business integrity? Have they had previous borrowings? If you visit, are you able to identify the business is there? I think those are very key, because if I tell you I'm doing serious and I have a store, is that store there? Is that business there? I think it's very important to have that character. The issue of capacity to repay, I think I talked of that. The issue of financial ratios, the debt ratios. Does the business need that money? I think the analysis from the bank side of it, or from a lender's side of it, we also do that analysis. Then collateral, fallback situation. This collateral means secondary is not the primary source of repayment from a bank perspective is the cash flows, but collateral comes in as a second way out. In case the person defaults, what then would you take in? As I said earlier, whatever we lend is customers' deposits, is not bank's money. And for this, we have to have a second way out. I talked of conditions, and I talked also of the capacity, the capital share in the business where the customer is coming from. I want to go to my second topic, and as I go there, I want to continuously encourage that if you have any questions, raise them through the chat, feedback, and even experiences, because most of you are business people. What experience can you share with your colleagues, with us here, in terms of the running? So my second area is, if you are to select a loan type, what would you consider as the best facility from an institution? So I know I've mentioned the issues like restocking, operations, and expansion. So if you are the purpose that you're looking for, if you're looking at restocking, you are looking at additional stocking, you're looking at business operations, you are looking at business expansion, the facility then for you is a short-term facility. So don't go to a bank and say, I'm looking for a facility of 120 months to finance my stocks. I'm looking for a facility of 120 months to pay for business operations. That would be a mismatch of the facility. Then if the purpose is an emergency, just as we said, or maybe some expansion that you need to make quickly in your business, there will be what we call an overdraft. Again, these are short-term facilities. An e-credit facility will be a short-term. If your purpose is travel, where you may not predict the actual cost, the actual expenditure, I think then the type of facility that you'll be looking for is a credit card, where you are charged interest on what you borrow, and you are given some credit period. So a credit card again becomes important when you are going to do things like travel. When you are buying movable assets, acquisition of maybe motor vehicles, acquisition of equipment, the facilities then that you'll be looking for will be asset financing and leasing. And I think those I'll be explaining about them from the core bank perspective. Asset financing, and if you're looking for a movable asset, you don't go for working capital. You don't go for, you are buying an equipment, don't go for working capital, you go for asset financing or leasing. If you are looking towards a property acquisition, an asset acquisition, be it land, be it a house, be it business or personal, I think the facility then that you're looking for is a mortgage, because most of these assets may not be income generating, and they can only be paid by what you get from the business or from a salary. So that will be a mortgage loan. The property acquisition again will go through a mortgage loan. Bridging financing or import and expansion, if you are in importation business, or some some contract business, we may be looking at invoice discounting. If you have done the surprise, you have supplied the goods and you have some shortfalls, you may discount that invoice into the bank if you have invoiced the buyer. Again, you may do contract financing where you have an LPO, you have an order, and that contract can be used to borrow, what we call contract financing. Again, that is short-term financing. And when you are doing importation, and I think this is where now we have a lot of people falling into issues. When you're doing importation, it's always advisable to use letters of credit. That helps you in terms of reserving the cash in the business for the period for the period that the goods coming or the machinery coming. So when you're doing importation, then the facility to consider will be letters of credit. I think with that, I would want to go to differentiating between good and bad loans. Good and bad loans, and I would want to pause here and maybe run an activity about good and bad loans. And on the chat, I request that you indicate from your experience, what are the signs of good loans, and also what are the signs of a bad loan. Hesbon, I think you can take that feedback. Maybe you could take a few, the signs of good loans and signs of bad loans. Thank you, Hesbon.
Thank you. Thank you. So the activity is indicate signs of good loans and also indicate the signs of bad loans. So you can post your feedback on the chat box. What, in your view, constitutes or indicates signs of good loans, and what indicates signs of bad loans? So we've have some feedback here. Just a second. Any loan that finances recurring expense is a bad loan. That's Martin there. Then we also have feedback from Abdikani Hamed, who says good loan is when you have secured business with their return profit margin. Then we also have Caroline saying good loans repayment constitutes repayment without default. That's the sign of a good loan from Caroline's perspective. Jennifer says good loans is where you are able to pay and not overpriced or underpriced. Then we have an interesting one here from Karen, who says bad loans are for leisure and cannot be paid back. Then we have more feedback. There's Unique who said bad loan affects income or is more than the income. So I think he's saying that there's one sign of a bad loan is a loan that affects income or is more than the income. Then Emma says a bad loan is one that a borrower is unable to pay. That's number one. And then number two, a loan that is not utilized for what it was intended. Then we have Haron saying good loans. Says good loans, a loan is good, does not need to sign many documents and helps in emergency cases and make sure no default. Steven says good loan gives you humble time to pay. So that's some of the feedback we have here. I can take a few more. We have Bon, who says a cheap loan is a good loan. Then Mary Wanjiru says good loans bring upgrading to the business. More feedback here. Samuel says a good loan is that which, if well utilized, will add more income into your pocket. That's some of the feedback we have received here. Then finally, we've had more feedback from Matthew, who says a good loan is that which times repayable because due diligence is not done. Bad loan is a loan that is borrowed unnecessarily and most times unrepayable because due diligence is not done. Can take one more. Caroline says Gideon say, yeah, that's the feedback we've had so far. Caroline says a bad loan funds diversion, hence cash flow wrong. Then someone says a bad loan is that which is used for the wrong reasons. Principal agent problem. Back to you, Moses.
Excellent, husband. I think with that, I don't know whether these are bankers responding or these are participants, MSMEs, because that's perfect feedback in terms of good and bad loans. But I think what the comfort that I get is that most of us have done lending, either at personal level or even have done borrowing, because those are perfect examples of good and bad loans. And I'll now summarize quickly my thoughts on good and bad loans. So in terms of good loans, they help you in terms of developmental purposes. If you see you are borrowing and your business is not moving forward, just as I said earlier, or even your personal, at the personal level, you are not moving forward, then that is not a good loan. The good loans will be able to generate income for your business. A good loan will help you add an asset in your business. And I think we have had that. Some good loans have reasonable costs of borrowing. And I think I've had that. Business can repay comfortably. And I think that is the most critical. A good loan is where the business can be able to repay comfortably. And a good loan is budgeted for. It's a plan that you have. You say, this is what I want. This is what I need to do. The bad loans, I think from the feedback I had, we had more examples of bad loans than good loans. I don't know why. But I think what you're saying here is that a bad loan is that facility that you borrow from a bank or even from all those sources you said, from a friend, from your savings, and you use it for consumption purposes. That definitely will be a bad loan because if it's consumption, then it is not generating any income. A bad facility drains income from your business. You see you have borrowed, but instead of the business moving forward, you drain all the incomes from that business. A bad loan can cause loss of assets to your business. I think that is basically what we said. When I said an asset is a collateral, is a second way out. If you borrow and you find yourself losing an asset, if you borrow and you find yourself maybe the motor vehicle being repossessed, it means that is a bad loan to your business. Excessive cost of borrowing, where we have those excessive cost of borrowing. And I think I highlighted a number to say we have other financiers who have very high rates, Shyrox, money lenders would have very high rates of borrowing, and they will keep you in a cycle. It becomes like you have a cycle that you have to keep refinancing the facility from them because they are short term, they are paying on monthly basis. That is bad borrowing. Strains the business to repay, again, is a bad borrowing. And any facility that you borrow that has no budget, to me, is a bad borrowing. So basically, those are the things. And the more importantly is what has come through from our participants in terms of the bad loans. But all is not lost. I think we go to a topic that is dear to me, what we call loan management strategies. As we said, if you have to expand your business, there will be several ways of funding that business. And one of them is borrowing. So if you have a debt, the most critical part is how then you manage. What strategies would you use in terms of managing your debt? And before that is to share a bit of insights on pitfalls in loan management. If you have a problem, those things that will put you into trouble immediately once you do loan management. Number one is what we call loan diversion. If you borrowed for example, to buy stock, and you go buy a motor vehicle, from day one, you know you have a problem. If you borrow to finance working capital, you go do investment capital, from day one, you know you have a problem. I think that diversion is very critical. So if you are to borrow, I think let's stick to the purpose. When you are borrowing a loan for a new business, a business that perhaps you cannot even quantify the ability to repay, the ability to generate income, again, becomes a a problem because you need to quantify that the ability of that business, the ability of the idea to repay, I think needs to be quantified before you go into borrowing. One of the other big problems that I see in MSMEs is poor record keeping. This, I think, is very critical for us to have very good records when you borrow. Just as I said, why am I borrowing? The amount, the installment, and the date. I visited a number of MSMEs, and mostly I'll go to a shop, and you see the customer even has displayed the what we call our own schedule in the business. It reminds them on day-to-day basis that I have an obligation on 15th, I have an obligation on 10th. I think today we have better ways of management, which is even electronic. You can put a reminder on phone. You can put a reminder to say that my loan comes due on 14th. My loan comes due on 24th. So that it keeps reminding you on the dates. But if you have no records of even what you bought, you have no records of what you are selling, you have no records on when you repay your debts, I think that will put you definitely into a problem. Then the other thing is overborrowing and including expensive loans. Just as I said, if you are going to borrow from a Shirok, if you're going to borrow from those money lenders, overborrowing and expensive facilities, I think will put you into problems. The other issue is the issue of poor cash flows. And poor cash flows comes in when you are unable to correct your debt. For example, if you are buying from you are buying goods and selling, and for you are buying cash and you are extending credit to your buyers, you'd have a problem, because at a certain stage you'd have a problem. I would rather you buy credit and correct cash from your buyers. But if it's the other way around, you have a problem. So it's important that you ensure at all the time cash flows come in banking. And I think this I need to tell the participants. We say cash is king. Banking, we say cash is king, because a debt is paid by cash. Your business may be profitable. You may be saying I'm making profits from the business perspective, but you are not able to correct cash, because profitability can be accrued. I sold a product at a margin of maybe even 100%, but I've not been able to correct that cash. So that profit would only be realized when you correct the cash. So cash is king, and debts are only repaid from cash, not from profits. So even if your business is profitable and it has no cash, then you'd have a problem in terms of repaying debt. That's why cash flows will be very key in terms of managing the business. So cash flow management, and we maintain cash is king. Failure to read the conditions that you get from a bank, so or from a lender, I think is important to read and understand the conditions. And failure to plan, I think we have talked of that. And poor correction strategies, I've talked of that. If you are buying credit, you are buying cash and you are selling credit, or vice versa, you are buying credit and selling cash, or buying cash and selling credit, I think it's important to match the period. We are not saying it's bad to sell credit, but it's important to match the period and what you are selling. So let's ensure that whatever we sell, we correct. Because if, for example, you are borrowing your money and it has a cost, and you are extending that credit to the customer, to your customer, it means you'll be paying the cost of that. And what that means is that your margins will reduce. Sometimes they go to negative if you take too long. So that's if you are selling, I think it's important that you have very good credit policies with your customers to just ensure that you maintain your profitability and meet your cash flows. So how then do you process the process of loan management? Identify the need of the loan. I think we talked about that. Plan. Weigh available funding options. So identify the need of the loan. I know most of you talked about that. Available funding options, just the options that we talked of, be it from the family, from the bank, from my savings. Is there a need? What are those available options? Can I buy credit from my supplier? Evaluate your borrowing considerations, just as we talked of, and select the right type of facility. So I keep emphasizing on this because it's important to match the need and the purpose and the facility that you're looking for. If it's working capital, if it's financing of stock, it's working capital. If it's short term, it's working capital. If it's investment, it's maybe investment capital. It could be a long term or a medium term kind of period. Use cash flows forecast to plan loan repayments. And I think I've talked of that. How then do you plan your cash to forecast your repayments? And this goes to say, if I receive my cash on monthly basis, I should be able to repay a facility on monthly basis. If I receive my payments on my cash on termly basis, I should be able to pay. We even have yearly facilities where the cash comes in on yearly basis. So do not go borrow money that you expected to pay in a month on a monthly basis for a facility for a project that will give you return on yearly basis. So much your cash flows and the repayment, the loan repayment, the installments, another. Then it's also important to track your own repayments. How do you manage challenging loans? I think again, very important. You have, I know you talked of bad loans. Is it necessary bad to have a bad loan? I don't think it's not bad, because we have challenges, just like what you went through the other day in terms of COVID. Most of us had challenges in terms of repayment. We had reduced business of operating hours. We had curfews. We had even lockdowns. I think those are challenges that came in. But how then do you respond to that as a business? I think that is very important. And just as you go and perhaps you have borrowed from a family or from a friend, and you tell them, I'm not able to meet the repayment, it's also important to engage your bank and tell the bank, I'm not able to pay because of ABCD. I think that's the point that most of us miss. When you have a problem, most of us would hide from the bank. You not even pick calls from relationship managers. You hide away from relationship managers. But I think what you are saying, if you have a challenge in terms of repaying your own, it's always very, very important to engage your relationship manager and disclose your current situation. I have a problem in terms of trading, I have challenges, A, B, C, D, and I would want support. That disclosure is very key. At the point, even when you foresee it, you may not even have experienced it, but you foresee to say, I foresee I have a challenge in the month, in the following month because of A, B, C, D. So let's disclose our challenges to the relationship person, the person who lends to you. I think is very important. Sometimes it can go to the extent of even requesting for a restructure. By a restructure, we say we are changing the payment dates. Maybe you pay your own on 10th, you are on 5th, you are a landlord, and your tenants have not paid. They tell you they'll pay on 10th. Why don't you go to the bank and say, rather than pay on 5th, I would want to move my payment to 10th. I think that's what you are saying. Change your repayment dates based on now the experience. And any banker, any lender would understand when you go to them and say, I would want to restructure. The other point of restructuring is to say your levels of trading were high, they have reduced. You would want to match your repayment to the current situation. Again, that is very critical, and it is a challenge that most of us live with, but it's important to see your banker, to see your relationship manager and tell them, I would want to reduce my repayment maybe from 10 to 5,000 as an example. I think that is matching your repayment to the current cash flows and to the current situations. And I think one of the key considerations we look for all the banks is banking your income, because the bank will only consider what goes through the statement. It's important to have the bankings coming through. Then we are saying request for additional funding in case of an incomplete project. Sometimes you may plan and there comes in cost escalations. You have a project that you wanted to do, but the funding was not enough. Rather than again struggle to say, I would want to run a project that I wanted to run in a year to the next 3 years, sometimes it's important to go back to the bank and say that the funding given or the funding given was not adequate for me to complete the project. So I require additional funding. And I think that discussion with you and the banker would help you so that it facilitates in terms of unlocking both sides, the capital that you have invested and also the repayment of the facility at the bank. Then consider reducing debts in cases of bullet repayments by your customers. Sometimes we may call them windfall, but they are very important. They are very good sources of repayment. You have some money that has been owed to you by your customer for long. You are struggling with a bad debt, with a bank debt. If you get that money, push it to the bank to reduce your debt as a windfall. My next slide, and before I go there now, is what solutions do we have as a bank in terms of sorting out the MSMEs, the borrowing needs of MSMEs. Before I go there, maybe Hesbon, I would want to just throw it back to you. 1 or 2 questions that that I can answer based on what you have gone through. Then I'll go to just giving the solutions that we have as cooperative bank. Back to you, Hesbon.
Thank you so much, Moses. There are so many questions here, and thank you for the insights. So I think one of the questions I've seen coming up, but maybe before I ask, before I present the questions from the participants, I can take this chance to ask my own. And that is, I think most of the things we've seen here is about the challenges in accessing credit. But speaking broadly from the perspective of, borrowing and repaying, we know when people don't repay their loans, they are maybe, listed on CRB. But are there any benefits of good borrowers? What benefits will good borrowers get from facilities that are extended to them? So is there any reward? Is there any benefit for an SME to pay their loans promptly from an access perspective? The other question I have here is from a few people. There was one who's asking, what do they do? They are already in the bad loan situation. They have taken bad credits. What would be advised to them? How do they get out of that mess? Then there's another question here about this is Martin. He says he had good, how can he access credit for business, for other businesses, considering that he had a business before that was doing well, but then when COVID-19 hit, the business is now not doing well. And one of the requirements he says is that, the lender requires him to provide current statements which cannot support further extension of credit. So what we advise to him? The question is that the business was doing well before COVID, it was hit by COVID, but he wants to get more money for another business which he cannot access based on the condition he has for the current business. Then we have another question here from Bon. He says, this is Gideon, sorry. He says, is it advisable to borrow for building, real estate? So I think you can take those and then, I can add more as we get along. Are you there, Moses?
Yes, Hesbon, he's in the call. Just a minute, he's responding.
Okay.
Very short time.
Yeah, so thank you all for sending in your questions as we wait for Peter to come, Moses to come back. We can keep sending in our questions. I think we've had a very, very interactive session. We have over 300 of us on the call today, which is really exciting. And I think from the feedback we see from the chat box, Moses, we are having a very, very interactive session here. I think our participants are enjoying the session.
Thank you, Hesbon. I take the questions that have come through. I think very good questions. And the first one coming from you, the benefits to the good payers, the good borrowers, I think a very good question. What benefits then do a good payer get from the bank? Number one is continuous borrowing. That is the greatest benefit that you can get. If you pay well, you can continue borrowing. Number two, I think banks are going to what we call risk-based pricing. And for the good payer, then we may get to what we call differentiated rates. And that will be very key. The risk-based pricing, I think, is all about that. That's a benefit then that we pass to our borrowers. And I think that the continuous borrowing, the growth in terms of the borrowing, I think that is very key in terms of repaying very well. And of course, if you are a good payer, the bigger benefit is that access, that continuous access is key. When you are in a bad situation, as I said, it's not a problem. It's not a very big problem because you're in a situation and you understand that situation. The only thing then that you need to do is to get to your bank, get to your relationship manager, explain the situation. And one of the things that we do, and most banks will do, is help you restructure the facility. And I think if we identify that there was a problem, we should then be able to cure that problem and get you back on feet and get you back to a good repair. So don't hide from your bank. It's important to see your bank and say, this is the situation I am in. This is what I'm generating now in terms of cash flows. And the bank would have an option of even matching your current cash flows to the loan repayment. I think that is very important for us to ensure that we engage and see we meet our bankers. So don't necessarily consider it as a mess. And it's important. Sometimes one of the things that happens when you find yourself in such a situation, let's discuss those options with the bank. And the bank will get you into the advice then to advise you into then how then you can come out. Some things would even be disposing an asset. If you have an asset that is idle there and you feel that it's not giving you value, and you have some debt that is accruing in the bank, I think even discussing that asset helps in terms of now getting to. So you have to get innovative in terms of then how do I manage this debt, considering that what I said earlier, that the money the bank gives you, the money the lender gives you is not from there, of their own. It comes from other depositors. But the most important part is engagement. So the other one of the provision of statements. I know as a bank, and this one I would want to speak from the perspective of cooperative bank. As a bank, we are cognizant of where we are coming from. And if your business line the business line that you have as a challenge, is that discussion there that we need to have with you. We may not necessarily look at what you are doing. I think one of the key things in business is that entrepreneurship skill, that ability to generate, to run a business, that entrepreneurship skill is we look at. And perhaps during this COVID period, we have been looking even at the past history of the customer and give them the consideration. So the performance, I think the current performance may not give a full picture of what you are doing previously. So we'll consider even the statements that were there earlier before. Of course, what you are doing currently will be considered, but you'll give a lot of emphasis and weight on what you are doing earlier before for us to provide the statement. So to that customer who asked that question, I think it's very critical to say, see your bank. If it's you are banking with us, see your relationship manager, and they will be able to guide you. And your current situation would not hinder you from accessing a facility. And as a bank, and I think we came through, as an industry, we came through in terms of supporting, extending even structures, moratoriums, and all those things when COVID came in. So we do understand, and we'll be able to handle case by case based on the need and the current situation of the customer. Real estate, again, we do consider funding real estate. And this, I think, is what I called the long-term funding. We have a lot of facilities that we do for real estates for our customers, and even I know banks also do that. Yes, I would want to go to the presentation. Esbon.
Thank you, Moses. Before you proceed, maybe you can take one more related to that. There's a question here from Bon who says he's in an endless cycle of borrowing. His business is in an endless cycle of borrowing. What advice can you give to him?
His business is in an endless cycle of borrowing.
Yes.
I think a very good one. I think that would be what I called a mismatch of the facilities. That's what I would think. It could be a mismatch. But the most important thing for the customer, I would advise them to see their bank. Just see your bank. They should be able to get you out of that. And maybe it's a mismatching. Maybe we're taking short-term facilities for short-term facilities for long-term needs, or the other way, long-term facilities for short-term needs. So let's match the need with the facility. So a clear understanding, the bank would help you once they clearly understand what is your need, and then they'll structure you based on the need. But that cycle, I think the key thing that comes in is the issue of the structure.
Thank you so much. I think you can proceed. Thank you.
I can proceed. Thank you, Hesbon. And now, Co-Bank MSME Solutions. And for this, I know we have a number of my customers. Just as I said earlier, an MSME would have 3 needs, or a business would have 3 needs. And the first and basic need is a transactional need. Before you even go to borrow from a bank, you have a transactional need. You are in business, you are selling, and you want to a place to keep your money safe. And that place is Cooperative Bank through what you call the MSME packages. You have a gold package, you have a silver package, you have a bronze package. Those are current accounts that gives you several options there, and they are differentiated by the size of the business. A bronze package is the person at the entry point. A silver package is a bit established, and a gold package is a person who is not well established. So all of them have different solutions in terms of the balances, the transactions, and even the correction solution. The second need, so if you are here, just before I go to the second need, if you are here then and you do not have a bank account as a business, I think that will be the solution for you. For those who are in Cooperative Bank and maybe you do not have this solution, a gold package, a silver package, or a bronze package, I would request that you see your branch. For those who are joining us and they are new to Cooperative Bank, I think in the chat you could indicate where you are. We'll get somebody to indicate your nearest branch. And your number, we'll get somebody to reach out to you. Then the second need is after you sell, after you operationalize your business and you sell, you have that need to pay. You have that need to correct, because you have suppliers that you buy from. You have people who buy from you that you'll be paying. So you have what you call payment and correction solutions. So number one, when you sell in cash, we have branches open. We have 150 branches that you can go deposit your money in cash. We have agents all over that you can use in terms of deposits. But COVID has taught us other ways, what we call the digital solutions. We have M-Cop Cash that is on phone that will help you in terms of paying into or out or pulling your money from the bank. We have M Collection that would also help you in terms of paying into the bank. We have Coop Online, a very versatile system that helps you in terms of transacting online. We have Coop Kwa Jirani agents. These are banks near you. A Coop Kwa Jirani agent in your estate, near your business. I saw a number of you saying you are agents. A Coop Kwa Jirani agents helps you correct and pay and helps you collect into your account, also pay from your account because they will be cash in and cash out from a Coop Kwa Jirani account. So you do not agent, you don't have to go to a branch. The POS merchants, I think those are also there. Lipa na M-Pesa termination. If you have money that your customer pays through M-Pesa, you are able to push that money into your package account, the MSME, the silver, the bronze, and the gold package. You are able to pay, and even any other account in Co-Bank, you are able to push that money into the bank account from the Lipa na M-Pesa facility. So you have transacted, you have collected, and you have a borrowing need. So that is that need that we call the lending solutions. You have a number of lending solutions, and I'll specifically talk about a few. Number one is what we call unsecured facilities, and I think this goes to the person who is banking with us. If you're looking for unsecured facilities, if you're banking with us, it's possible under the packages that I talked of. We also have secured facilities that are secured by legal charge, that is a title, or by us an asset, a motor vehicle. We have a mobile facility that comes through mobile. This is unsecured up to $1 million, and I'll spend a bit of time maybe in the next slide on that. Then we have asset financing, we have mortgages, and even we have trade financing. So those are the lending solutions then that we offer to you as a business. So that completes now the 3 needs that I talked of: the transactional need, the correction and payment, and the lending need of a business. In Cooperative Bank, we have all those solutions. Just a brief in terms of working capital. For unsecured facilities, we go up to 10 million. Depending on the level of the transactions that you have with the bank. Working capital, we may use household items, you may use motor vehicles, you may use business equipment as security. So if you are here and maybe you're saying, do I need to have a title? What I'm saying is that you may not need to have a title. As far as you have transactions coming to the bank, you may get both an unsecured facility or even a facility that is secured otherwise by household items, business vehicle, other vehicles or business equipment. Then we have what we call tangibly secured. This is, we are saying you have cash, you can even take a title. That is what we call tangibly secured. Then you have group loans, formal and informal groups. This is where the group comes together and they co-guarantee, the members co-guarantee. This at the micro level, but a very good empowerment tool where the group savings helps you secure the facility, where members come together. And I believe Inuka Enterprise Program was for such kind of engagements. Then you have guaranteed working capitals. Working capital facility. This is mostly, we have a facility that's guaranteed by government, you have a facility guaranteed by other entities, and mostly this is to registered businesses. This is a person who has registered as a business. We have supplementary loans, and this is what we call, it helps you sort your emergency needs. As a business, you also have your personal needs. You are borrowing for working capital, but you have maybe a kid that you need to pay school fees for. You have some medical needs as a business. Do you have to go to your business to pay for medical? Do you have to go to your business to pay for school fees? We have a facility that we call supplementary. So this goes to the business people to help them sort out their personal needs. So you have some personal needs that you want to do, and you cannot get that money out of business. We have a facility of up to $1 million that helps you in terms of sorting what we call the personal needs for a business person. Then we have partnered with several counties just to finance their business, the business people in those counties. And I think we have a number that you are working with. Then the sales in terms of collections, the enablers, what helps you in terms of collecting, I talked of repay and M-Pesa, is an instant deposit with no extra charge. So your money you push from the correction, the till, the repay and M-Pesa till and what have you, push it to the bank or from the M-Pesa account if you are collecting on send money. That helps you in terms of terminating your funds into the bank account. Then the micro payments, this is where the till is registered as a mobile number. We have a till number registered as your mobile number, and you collect in as much as 2 million, a limit of 2 million on daily basis. If your business is setting up to 2 million, you can collect on that mobile number and push it to the bank at the end of the day. M correction is our unique number, 400-222. This gives you the payee, details of the payee. Again, it has no bank charge. So again, when your customer comes in, their money is on phone. They don't have to go get cash. I think you can ask them push but directed to my co-op bank account using pay bill 400-200. It helps you in terms of even, it gives you the narration and it gets back to you instantly, giving you an SMS to say so and so has paid into your account, and with that it gives you a confirmation to release your goods. And then the issue of co-op kwa jirani, we are saying if you're interested in operating one as a business person, because this is done by business people, you are open to apply. It has some payments that you make from the bank based on the transactions, but it helps you cash in, cash out, and several other transactions that would happen. I would want to spend a bit of time here, just a few minutes, because this is what we call the e-credit facility for businesses. E-credit facility for businesses on your phone. If you dial *667#, you get a limit of up to $1 million for a period of up to 6 months. This is what I call short-term facilities, working capital. Who qualifies? Of course, you have to have an account, a transacting account with us, maybe as a sole proprietorship, or as a partnership, or as a limited company. So the basic criteria for qualification is that your account has to be having cash flows, and the bank accords you a credit score, and you have also to be on Co-op Online. What I said, the Co-op Cash and the Co-op Online. This facility can run concurrently with other working capital, a mortgage and asset finance or credit facility. So if you have an account with us, you have another facility, e-credit, you have a limit available up to $1 million based on your score. And of course, the transactions that are coming through your account in Cooperative Bank. When I talked of asset finance, I meant motor vehicles here. I meant equipment, but I would want just to say, without going into much of the details, to say we have a number of schemes with all the motor vehicle dealers, new motor vehicle dealers in the country, the Isuzu, East Africa, Simbaco, Toyota Kenya, Nissan Kenya, Tata. We have all those some for tractors. We have all those schemes that will help you acquire a motor vehicle, a tractor, some lorries, equipment that you need for business development or facilitating your business. Then we have machinery and equipment. We have various partnerships with most of them that will help you in terms of financing equipment. Again, when I talked about long-term financing, is mortgage. Again, as a bank, we can have what we call plot purchase, house purchase, construction. We can do construction. We can do equity release. All those that would help you in terms of acquiring a mortgage facility. I think that is the end of my presentation. In conclusion, and just recapping what we've covered, we've talked about borrowing considerations, and I believe with that now we are left with some notes in terms of the considerations. We have talked about selecting the type of loans, and I think that came out strongly based on whatever, on the feedback that came through. Difference between good and bad loans also came out strongly from yourselves. Loan management strategies, and lastly, I've talked about core bank MSME solutions. And with that, on core bank MSME solutions, I would want to invite you to patronize our branches, our centers. The branch that is near you, we have a business banker or a branch manager then who would help you in terms of getting those solutions. Have we met our objectives? I believe now we are able to access more credit for business growth based on the feedback that I've gotten, even the questions that came through. You should be able to match your own products to your business needs, also based on the feedback that I've gotten through. And more importantly is differentiating between a good lender and a bad loan, and also the issue of managing your business for better. So I would want to open up the session to share the comments, questions, and even feedback. Hesbon, feel free also to share feedback from the participants. Back to you, Hesbon.
Thank you. Thank you so much, Moses. I think you really made a very comprehensive presentation. I think from my end, what I see as the participants share their questions, maybe I can share what I may consider the key, takeaways from today's presentation. So from my point of view is that you really have comprehensively addressed, the topic, and by addressing the expectations, what borrowers or SMEs expected of. And I think that will go a long way in informing them as they, approach lenders for credit. And really, I think the presentation has explored broadly on how, SMEs can enhance their ability to access credit. And I think there you've highlighted the fact that the reason why banks are careful in their lending is that the money they have is not theirs. The money held by banks is depositors' money, and so banks really have to be careful they lend it, so they have to really do all the due diligence. I think you have highlighted very key aspects here in terms of character. You've said the character is important in managing, accessing credit, capacity to repay, access to collateral, capital, and conditions. I think I learned here that it's not encouraged for one to take a loan for a startup. I think it's that's one of the things you highlighted in your presentation. And I think what I learned from your presentation also is that controlling debt is really, really key in the success of a business, and it has benefits if it's managed well. And I think you have extensively shared insights on how to manage credit well to grow a business. I've seen feedback here from Maggie, who says we have had a very informative session and is really appreciating the session. We have the same feedback from Justus. We have an interesting one from Joseph Otieno, who's asking if there's anyone who's willing to repay his loan because his business has failed, and he fears that replication of may help now. The other one is about from Joseph, who is thanking us for today's session. And then there's one from Daniel who's asking how much does he need to have his account for the bank to construct a rental of 20 million. So I think we have had so many questions about specific products, and I think we'll be able to share contacts where the participants can really reach directly with the bankers to be able to advise them on the various aspects. So really from my end, I think we want to thank you once again for today's session. I think I've also learned a lot from your presentation today. So I'll hand it back to you so that you can do a summary and then wrap up. Thank you so much.
Thank you. Thank you, Hesbon. I think Peter from Cooperative Bank, Head of Non-Financial Services, is also with me. Peter, maybe you have a few questions that you could pick before I go to the wrap up. One or two.
Okay. Can mute from your end as I check to see one or two questions. Yeah, thank you so much, Moses, for the great presentation and the information that you provided on the loans, and then why we also need to take care and plan for the facilities. I see someone has asked, do we still finance the business plus loan facility for the e-top-up, the e-loans, and also the top-ups? Maybe you want to say something on that. Somebody had asked, would you advise to have a mobile loan for financing an LPO? Maybe Moses, you can answer those ones first as we try to maybe look for other questions.
Yeah, thank you. Thank you, Peter. The issue of e-credit and top-up, we now call it refinancing, and it's available. So once you go to the menu in terms of picking the facility, we have what we call refinancing. It's available for business customers. So we have that refinancing option. LPO and e-credit, again, a good idea, but as I said, this is a short-term facility. Then you have to have agreed your repayment plan, the repayment plan with the buyer, so that again you do not take a short-term facility for a long-term need. So you have to agree with the repayment facility, rather with the buyer on the credit terms that they provide, so that if it's short-term, credit will be a perfect solution. If it's long-term, I think seek a formal bank facility.
Thank you, Moses. Doreen is saying, then raise the mobile banking loan repayment from 6 months. She's saying she's from Ukunda branch. Thank you so much, Doreen, for that comment. I will ask Moses to also comment on that. I see Glorious also is indicating that she appreciates this training. So maybe Moses, you want to address the issue of the loan repayment date, rather loan repayment period for the e-credit, and possibly maybe the plans that the bank also have, maybe to enhance the limit, maybe from the existing 1 million. I think I see also Patrick also indicate on the need to check on the loan repayment tenor, maybe to increase on the same. And maybe Moses, you want to comment on that?
Thank you. That's very good feedback from my customers. The e-credit facility, we have a maximum tenure of 6 months. The extension is good feedback in terms of consideration. But just as I said, this a short-term facility that will help you in terms of meeting the needs. But I've taken that feedback of the tenure and something that is under consideration based on the fact now that we should be able to even lend more. The other thing on the amount, it's under consideration to it to a max of about 2 million. And I believe we'll be there shortly. For now, we're at 1 million, 6 months, but we'll be there in a very short time. We'll be at maybe 2 million, and that will be communicated maybe once a year there. But the issue of qualification, again, to clarify, is that it's based on the transactions that come in. So if you are here and you enjoy that facility, I think I would want you to consolidate your banking. It will take you to the highest limit and the best course out there. It's based on the transactions, the credits coming into your account, what we call the turnover, the number and the value. So ensure you direct all your business income into that account. I think that will help you in terms of qualifying for higher amounts. Thank you, Peter.
Yeah, I think those are the questions that I have picked from my end, and
Yes.
maybe back to you, Moses, just in case there's anything then that you want to address as you take us to the next part of the session. Thank you.
Thank you, Peter. I think I would want to take before I go to my parting shot, as Hesbon had asked. I would want to just take us to a call to action, because when it comes into such a meeting, it's very good to discuss, but I think we need to also to leave with a call to action. And one of the things that I've emphasized is that as an MSME, you need to maintain close relationship with your bankers, the branch managers, for information and support. We may have discussed this topic, but I know we've not shared as much. Your bankers, your managers, regardless of where you are, but more importantly, in Cooperative Bank would help us give you past information and support you based on what the needs, that understanding. And I keep saying a banker-customer relationship is like a doctor-patient relationship. Until the banker, unless the banker understands you, they may not be able to support you well. So it's important that your banker understands you, and at the branch level, you have a banker and the branch manager then who will be able to support you. For those of us who are not in Cooperative Bank, I encourage that you open MSME package accounts. They are available. And we just need your identification documents, that's your ID on the business registration, and a minimum of some minimum balance to open the account. So let's open those accounts at Cooperative Bank. I think the other thing that I would want to say is let's leverage on our payment solutions to bank all your incomes. So as I said, I think we have gone digital. Above 95% of our transactions are now being done digitally, and we want to do people to take advantage of the payment solutions. We have very versatile payment solutions that will help you pay and help you collect at your business, even reducing the movements to the bank or the movements to your suppliers and what have you. So let's take advantage of those payment solutions. And I think the other one is the issue of disclosing your financial needs to your bank manager and the branch manager. So that disclosure is very important to your branch manager or the banker, so that they know exactly then what solution they can prescribe for you. Lastly, I would want to encourage you to visit the CoBank MSME online portal. We have shared the address there. The site there, you'll see all the webinar recordings, including this, all the materials that we presented. We do, as I said, we do it every Thursday. We have a lot of insights there that can help you. All the recordings, all the presentations that we have done, I think you meet them there. And in the course of the presentation, I kept on talking about need to plan. And for this, I would want to say that failure to plan is planning to fail. So in business, I think we need to keep planning and planning always, so that then our plans would be able to help us, to guide us in terms of the activities, including the borrowing. Lastly, as a closing remark, which I think is also very important, is that we've talked of the why, the issue of debt management. And I would want to close my parting shot based on what we had agreed earlier, is what I discussed earlier, to say, number one, utilizing and controlling debt effectively is a key factor to personal and business success. I repeat, utilizing and controlling debt effectively is a key factor to personal and business success. The second thing is to say that debt is very beneficial to a business when managed well. I repeat, debt is very beneficial to a business when managed well. And I think the third thing is to say debt can sink a business when neglected or mismanaged. And I repeat it, debt can sink a business when neglected or mismanaged. Thank you so much for joining us. I've shared the contacts that if you want to reach us as Cooperative Bank through the business banking department, we have an email address there and even a telephone number displayed on the screen. Thank you for joining us and God bless you. Back to you, Hesbon.
Thank you so much, Moses. I would like to join you also in thanking the participants and wishing them a good day. Thank you so much.